Get on the bull.
S&P 500 program trade by level 1. By level 1.
Wake up call, pal.
Level 1.
Go to work.
Welcome to Trading with GB. Today we're stepping back from the immediate noise of the tape to look at the structural architecture of the global market. A new trader error is to treat your specific market like it lives in a vacuum. You get hyper-focused on the price action of the mini or gold or whatever and think the order flow is the beginning and the end of the story. Remember first-year economics with all those assumptions? We were taught about fixed exchange rates, a fixed balance of trade, and the ever-elusive rational expectations. Of course, we knew at the time those things shouldn't be assumed. They were just training wheels to help us understand the basic math. The thing is, even as we gain experience, we can fall into the trap of carrying little assumptions like that into our analysis. We look at interest rate differentials or the shape of the yield curve as if they are the primary drivers. But they aren't. They are the symptoms of a much deeper structural reality. If you want to understand the long-term mechanics of trade, you have to look at the plumbing that makes those market assumptions possible. For the last 50 years, that plumbing has been the petrodollar. In the classroom, they teach you ceteris paribus, all else being equal. But in the global macro space, all else is never equal. The reason the US dollar has maintained its status as the world's reserve currency isn't just because of rational expectations or the strength of the US economy in isolation. It's because of a very specific, non-rational, highly engineered agreement reached in 1974. When Nixon took the US off the gold standard in 71, the fixed exchange rate world was gone. The dollar was floating, and it was sinking. The solution wasn't found in a textbook, it was found in Riyadh. The US-Saudi agreement effectively backed the dollar with oil. By ensuring that every barrel of OPEC oil was priced and settled in US dollars, the Americans didn't just stabilize their currency, they created a global mandatory demand for it. Think about how that breaks the vacuum of a local market. If you're a trader in London or Tokyo, you might think you're just trading your local cross based on central bank policy. But if your country needs to import energy, which every industrialized nation does, you are tethered to the USD by necessity. That isn't a market assumption, it's a structural constraint. If you don't have dollars, you don't have power. Literally. This leads us to another one of those first-year assumptions, the balance of trade. In a textbook, if a country runs a massive deficit, its currency should eventually devalue as it prints more to pay its debts. Under the petrodollar system, that rule didn't apply to the US. This is the petrodollar recycling we talk about. When oil-producing nations received those billions of dollars, they didn't just keep them under a mattress, they recycled them back into US treasuries. But there's a deeper layer here that practitioners need to understand, the Eurodollar market. These are US dollars held in banks outside the United States. Petrodollar recycling didn't just fund the US deficit. It provided the offshore liquidity that allowed the global banking system to expand. This created a circular flow that allowed the US to ignore the balance of trade rules that apply to everyone else. It provided a constant artificial bid for US debt, which kept interest rates lower than they would have been in a rational or vacuum-sealed market. When you look at the long-term charts of the USD, you aren't just looking at economic performance. You are looking at the success of this recycling program and the massive offshore leverage it enabled. Now, we have to address why the long-term trade view is shifting. For decades, the US dollar was seen as a neutral utility, the plumbing that everyone used because it was the most liquid and reliable. However, we've moved into an era of financial weaponization. When the US and its allies froze Russia's central bank reserves, in 2022, they effectively changed the definition of a reserve asset. If you are a sovereign nation and your savings can be turned off by another government, those savings are no longer a neutral store of value. They are a political liability. This has fundamentally broken the rational expectations of central bankers worldwide. We are seeing a move away from the USD, not necessarily because people want to use the yuan or the ruble, but because they need to diversify their geopolitical risk. This is a massive shift in the long-term trade architecture. It's the reason gold has been hitting all-time highs, even as real rates stayed elevated. The world is looking for a neutral asset that doesn't live in the US Treasury's vacuum. Now, some say, right or wrong, that we could be moving into an era where we can no longer assume that energy trade remains locked in dollars. We're seeing bilateral trade agreements where China buys Saudi oil in yuan or India buys Russian oil in dirhams or rupees. This is the de-dollarization story, but we need to look at it through the lens of long-term trade mechanics, not just sensationalist headlines. If the mandatory demand for the dollar to buy oil evaporates, the exorbitant privilege of the US to run infinite deficits without currency devaluation begins to fade. The yield curve we watch so closely will no longer be suppressed by the automatic recycling of oil wealth. For the professional trader, this means the correlations we've relied on for 20 years are breaking. The safe haven status of the USD is being retested. We can't afford to fall into the trap of thinking the old rules. Those fixed assumptions from the 1970s still hold. Could we be moving from a world of global liquidity to a world of fragmented liquidity? That means more friction, more volatility, and more importance placed on understanding the actual counterparty risk of the currency you're holding. So finally, we have to talk about the energy transition. The petrodollar is, by definition, tied to a fossil fuel. As the world moves toward electrification, the currency of energy might change. We're moving from a world of liquid commodities, oil, to a world of mined minerals, lithium, copper, nickel. These markets do not have the same 50-year-old formalized agreements that oil has. Think about the trade mechanics here. Oil is a flow commodity. You burn it and it's gone. You need a constant supply, which requires a constant flow of currency. Minerals for batteries are stock commodities. Once you have them in the grid, they stay there for years. If the primary source of global energy is no longer a commodity that needs to be constantly repurchased on a central exchange in US dollars, the structural requirement for dollars to buy energy evaporates. This is a decades-long trend, but it is one that we must keep in the back of our mind. The petrodollar might eventually be replaced by the electrodollar, or perhaps we are heading toward a system with no single dominant currency, a world of commodity-backed bilateral trade that looks nothing like the first-year economics textbooks. It reminds me of something a long time ago. I was about to start uni and I managed to arrange some work experience at Prudential Bash, a big stock broking firm at the time. The Sydney desk, as I remember it, was big and the people there were good. It was an interesting mix of eccentric, old-school, cerebral and flamboyant. It was January 1990. But the 80s were still fresh in people's minds and wardrobes. I spent 2 weeks in the dealing room up there in Grosvenor Place, being passed from one desk or broker to the next. One of the brokers handed me a piece of paper and said, "Read this and tell me what you think." That week, I have to say I was nervous. While it was unpaid work experience, I felt everything was a test or a foot in the door for an interview. It wasn't, but it's how I felt at the time. And the article was an opinion piece on the state of the Japanese banking system, which at the time was, well, let's just say it was in serious trouble. The Nikkei was still at an all-time high. The worsening fundamentals were known to the economics and cerebral types, but the market refused to take it seriously. Sound familiar? That's the way these big shifts occur. They get talked about, debated by economists and published here and there, then dismissed by the smart money because the price action hasn't confirmed it yet. Then one day something triggers a move. The dam breaks and everyone else says, "Geez, how did that happen?" Funny thing though, my 2 weeks at Prubach was about the time of the absolute peak of the Japanese market. Big picture trades take time. They aren't about timing the exact top on a 5-minute chart. They are about recognizing when the structural flaw of the entire system has begun to rot. In 1990, people thought the Nikkei would go to 100,000. It took decades to recover. We are in a similar spot with the petrodollar. The consensus says it's an unbreakable pillar of the world, but the plumbing is changing right under our feet. You don't want to be the one still reading the old miracle opinion piece when the floor gives way. To wrap up, is the term petrodollar important to know? Absolutely. It is the framework that explains the last 50 years of US hegemony. Is it useful? Only if you use it to identify where the cracks are forming. We don't care about the politics. We care about the flow of capital, the flow that once moved reliably from oil consumers to oil producers and back into US treasuries is now leaking into other currencies, into gold and into bilateral trade agreements. The petrodollar isn't going to disappear next Tuesday. The dollar is still the most liquid currency in the world, and the network effect is incredibly hard to break. But could the monopoly be over? The exorbitant privilege is being challenged by the reality of a multipolar world. In a world where the plumbing of the financial system is changing, those who understand the mechanics and who refuse to treat their market like it lives in a vacuum are the ones who will manage risk the best. If it's a trade, it's a deep pocket, long-term shift trade. It's a hedge fund trade, not a prop desk trade. At the very least, it's food for thought. That's it for today. I hope this gives you a bit more context for what you're seeing on the charts. For more, subscribe to this podcast and check out my training site, masterclasstrader.com. Use the code trading with GB for 20% off and sign up to the newsletter as there are new things coming soon. Until next time.